Good morning, everybody, and welcome to our May accounting webinar. And in this webinar, we look at getting ready for 30 June 2019. So we're all slowly getting ready for the big bang, the busy season. Accounting standards update, what happened in the accounting world, what do we have to know about for our 30 June 2019 financial reports. What will we be looking at today in greater detail? First of all, we're going to start off with AASB Interpretation 23, which is uncertainty over income tax treatments. Now, I think that interpretation might have been slightly overlooked whilst we were all busy talking about AASB 9, 15, 16, and for our not-for-profit friends, AASB 1058. So we'll start with that one. Then we'll look at some very specific developments in Australia. In our third section, we'll look at standards and interpretations that would be effective for the very first time in our 30 June 2019 year ends. However, if you've got a 31 December year end, we also look at standards and interpretations that would be effective for the first time in your 30 June half years. Then we move on to standards and interpretations that's been issued, but they're not yet effective, so a bit forward-looking. The second last session, we look at some of the IFRIC agenda decisions and what's been happening there. And finally, we look at not-for-profit developments. So that's a quick overview of our session today. If we go on and immediately get into it, we start with AASB Interpretation 23 or IFRIC 23. Now, for this topic, we have two guest presenters from BDO. Mike Smith is a transfer pricing partner at BDO, and Jason de Boer is a tax partner at BDO. So I will hand over to them to run through the implications of IFRIC 23, and then from time to time, I might add a little bit of the exciting accounting stuff.
Great, thanks Aletta, and hello everybody. This is Michael Smith here, transfer pricing partner at BDO. I'll lead the conversation and Jason and Aletta will jump in with some comments as we go. So first I might start with a bit of a story. Back in 2003, I moved to the US for work and I spent 5 years there in New York. And halfway through the time I was there, FIN 48 was introduced for the first time in the US. FIN 48 set out how US corporates should treat uncertain tax positions from an accounting perspective. And the combination of FIN 48 and Sarbanes-Oxley were effectively a response to some of the accounting scandals that had happened in the early 2000s. So FIN 48 was a massive deal over in the US. It involved corporates forming risk registers of all their uncertain tax positions, preparing documentation that sets out recognition and measurement tests, and effectively putting together binders that supported the positions they'd adopted in their tax returns for review by their auditors. So I had the pleasure of being there when FIN 48 was introduced and going through the sort of first few years of introducing all that massive sets of documentation. I moved to Australia in around 2008. And when I got to Australia, I found there was actually a very different approach to the treatment of uncertain tax positions in financial statements. In particular, it was a much different discussion around when you might book a provision. So I found it quite surprising. I remember sitting in meetings with audit teams and clients and saying, you know, clearly there's something here that's uncertain. Clearly a tax office might take issue with it. But my understanding from working with, you know, a couple of large big four firms and the associated very large clients that we worked with at the time, the general treatment across the board was to wait until we had some sort of certainty that there would be an outflow of funds, typically in the form of an assessment from the tax office in respect of a tax issue, before we would book a provision. So that was very different to FIN 48, where you had to consider the technical merits of a particular uncertain tax position and book a reserve provision based on that at the time. So massively different, and in some ways I kind of feel like it was influenced by the Australian culture. We're a bit more laid back here. Until something becomes an issue, it might not necessarily be an issue. And I feel that played out a little bit in the accounting interpretation of uncertain tax positions. So now we've had some changes, and those changes in the form of IFRIC 23 internationally and AASB Interpretation 23 being the Australian implementation of that, that's effectively Australia's version of FIN 48 in terms of it sets out clearly how uncertain tax positions are required to be treated in the financial statements, and it provides clear guidance that effectively says corporates and their auditors and accountants actually have to measure these uncertain tax positions on a current basis based on the technical merits of that position and book provisions now well before they might reach the stage of the tax office commencing an audit, or before having that assessment from the tax office, which historically had been the case. So IFRIC 23, AASB Interpretation 23, in summary, is Australia's answer to FIN 48, and it has a lot of similarities with FIN 48 in terms of the recognition and measurement of uncertain tax positions in the financial statements. So big picture, I think this is going to involve a lot of change in terms of how taxpayers will need to assess those uncertain tax positions, the documentation and processes and procedures they'll need to go through before the audit takes place. And then from an audit perspective as well, there's an extra layer of diligence that the audit teams will have to do to understand and form a view as to whether they agree with management's assessment in respect of those uncertain tax positions. So this is basically leveling the playing field and making it very clear about how uncertain tax positions need to be treated in financial statements. Let's jump to the next slide, Aletta. So the key assumption, as we can see here, is, that the entity shall assume a tax authority with the right to examine amounts reported to it will examine those amounts and have full knowledge of all relevant information with making those examinations. This is the key sentence, I think. So what that means is you can't account for detection risk. You have to assume that that audit or review is going to happen. And you can't assume that the tax office might not ask the right questions. You have to assume they have all necessary information and they form a view based on the technical merits of the particular issue. So again, quite different to practice where we might have waited for assessments, waited for position papers before we'd have booked things. And how does the mechanics of it work? Well, you've first got to do the sort of equivalent to the recognition test. You have to assess each uncertain tax position based on its merits and determine whether it's probable or not probable that that tax position would be accepted. In other words, if it's probable, i.e. more than 51%, I would assess that the tax authorities would assess a position, then effectively your books are going to be lined up with your tax return. There'll be no differences. But if it's not probable, then you have to calculate a provision in respect of that particular uncertain tax position. How do you calculate that provision? There's two ways. You might use the most likely amount or expected value. And Aletta, if you jump to the next slide, I think we've got a bit more detail on both of those. So most likely amount, this is the single most likely amount in a range of possible outcomes. In transfer pricing, for example, the most likely amount is quite often the way you would use to calculate, because you typically would have a range of outcomes where you might be assigning probability. The single most likely amount, is when you've got the concentrated data. So where you've perhaps got option A or option B. And if you think that one option out of two options is the right one, then that's the one that you're going to choose and book, the single most likely amount. The one I was talking to previously, the sum of the probability weighted amounts in a range of possibilities, that's where you might have a range of possible outcomes, and you might measure or assign probability to that range of possible outcomes when determining what that expected value might be. So Aletta, I don't know if you want to comment briefly there. I know that most likely amount and expected value are common phrases within other accounting standards?
Yes, so we in AASB 15, when we talk about revenue, in AASB 137, when we talk about provisions, contingent liabilities, contingent assets, we use a similar concept. If there's two possible outcomes, we pick the most likely one, and expected value if there's a range of outcomes. The one that I'm thinking that we've discussed fairly recently in our webinar series would be AASB 15, where we've got in step 3 variable consideration. And we would say, if there is a possibility to pay a penalty or not, and it's only you're going to get the say that you're going to receive a particular amount, or there will be that amount less a penalty. There's only two possible outcomes. Based on our experience, we pick the most likely one. So it's something that we use quite a lot in accounting, Mike.
Thanks, Aletta. And Jason, any comments?
Yeah, Mike, just talking to the probable versus not probable discussion on the previous slide, to me the critical piece there will be the evidence that is able to support the position of probable. So to me, it won't be enough for a taxpayer to simply assert to their auditor that the position is probable. As you pointed out earlier, the important piece there is the documentation that goes behind the position to support it.
Yeah, absolutely. Thanks, Jason. And Aletta, maybe we should jump to the next slide, because we've got some comments there about what practically needs to be done and what documentation you might need. So practically, what you would need to do as a client, as a taxpayer, is develop a register of uncertain tax positions, evaluate the technical merits of each one, form a view as to whether the outcome is probable or not probable, and if not probable, calculate and book the most likely amount or expected value. So again, parallels with FIN 48. When I went through this process in the States, that process was sometimes quite a long process for some sort of multinationals that were headquartered where I was working. There might be a laundry list of uncertain tax positions that need to be considered independently or collectively. And from a documentation perspective, it was necessary to evaluate the technical merits of each one. So typically, if you can picture a binder, on the front tab of the binder, there might be the register, the list of uncertain tax positions. And then depending on how many you've got, you might have a separate tab for each position. And that tab would probably contain a summary of the facts and the background, the technical issue at hand, and then the technical reasoning as to whether it was probable or not probable, and if not probable, the calculation. Those binders would also contain any additional evidence or analysis that was needed to support that position. So I think the correct audit phrase is on this slide, and maybe I'll hand to Aletta briefly again to describe sufficient appropriate audit evidence and documented judgments in this case.
Yes, Mike. Now, I should first of all say I'm not an audit partner. However, I work with the audit partners and staff very regularly. But I think a key concept underlying audit is sufficient appropriate audit evidence. And therefore, it's very important that clients document their judgment, their thinking, their process in order to have that discussion with the auditor. I think quite often people, when it gets to a grey area, they tend not to document it extensively because, it is so grey, not sure, where it's going to end up. But the answer is, and the correct approach would be to document all the facts and circumstances, to highlight the different possibilities, the different alternatives, do an analysis in consultation with the experts and come up to a position that they can put in front of an auditor to consider and to discuss. Really important for auditors to have that sufficient appropriate audit evidence, and therefore a responsibility on management and a client to form a view and a documented view. I do think, Mike, this is a place where it's really important, where management and clients should consider using particular experts to help them to put this document together. So from an IFRS perspective, we usually often work with clients to put an appropriate accounting treatment in a document, so a client can have a discussion with an auditor about that particular accounting treatment. Now, similarly, we would expect a client to, if there's a particular contentious tax position from a corporate tax perspective, to maybe have an expert in that area, or if it's related to transfer pricing, work with an expert in that area. But to have a real good documented position to discuss with the auditor, and then obviously the auditor will have their own experts involved if required to have a look at what our clients have documented.
Yeah, thanks, Aletta. And I think there's a real interesting issue here where you're dealing with uncertain tax positions. You've almost got to walk a fine line between providing that sufficient appropriate audit evidence while not necessarily providing a roadmap to the tax office in terms of an issue you're thinking and, for example, where you might settle. Because when you prepare these documents for that audit purpose, they might be discoverable by the tax office. So I've spoken to clients before who have talked about that difficulty in both satisfying audit teams, but also making sure that they can not necessarily provide an easy win for the tax office should those documents, become subpoenaed and go into their hands. So it's an interesting practical challenge there as well, how you satisfy everybody and balance those different stakeholders. The last brief bullet there, this is probably a tax-related comment. There's a reportable tax position schedule which has been introduced recently. Corporates over a certain revenue threshold will have to complete the reportable tax position schedule. And there's a whole category in that reportable tax position schedule that asks taxpayers to pick up and document the uncertain tax positions that find their way into the financial statements under IFRS 23 and call those out separately in that reportable tax position schedule. So behind the scenes, you can imagine that the tax office is looking forward to obtaining some of this information, to getting a hold of some of the data to understand where those uncertain tax positions are that they might not have detected, or that they might have detected, but where they want to get a clearer roadmap of a corporate's thinking. In terms of other practical issues, there's a practical issue around forming management's view and dealing with your audit teams. So obviously, if your tax advisor also provides audit services, there's an independence risk associated with that. So that can potentially be managed with Chinese walls and that sort of thing. But typically, you would expect that the threat of self-review when it comes to forming a view as to management's best estimate of how a position might land might be compromised by having the same firm do both the audit and the transfer pricing work in particular. Maybe we should move on to the next slide quickly as well. So what we've done here is 3 brief case studies, just designed to draw out a few of the issues associated with IFRS 23. As an aside, I presented these case studies to a room full of industry professionals in the past 2 days. And we also ran some polls before and after we did the case studies, just to understand how many people were aware of IFRS 23 in the room, how many people had booked provisions in respect of uncertain tax positions prior to the introduction of IFRS 23, and how many people following this sort of education session were likely to revisit where they'd concluded on booking provisions and were more likely to book something different as a result of IFRIC 23. Just a couple of quick stats from that. When we ran the polls, probably about half the people in the room were aware of IFRIC 23 and the other half were not. And again, this is an audience of 100 taxpayers, clients. So there's potentially some catch up there to do in terms of understanding what needs to be done and when it needs to be done. The other question that was interesting was when we asked them how many people have booked a provision in respect of an uncertain tax position in Australia in previous years, and well over 90% of the audience had not booked an uncertain tax position in their Australian financial statements in previous years. So again, practically there's likely to be massive changes in terms of the accounting for uncertain tax positions and what gets booked as a result of this introduction. So moving on to the case studies briefly, there's a couple of transfer pricing related case studies here. Why are they transfer pricing? Well, transfer pricing tends to be one of those areas of tax where you have a lot of subjectivity and therefore uncertainty. Another area where you might have a lot of uncertainty would be R&D typically, because again, there's subjectivity to that analysis. So case study number one. This one's designed to be quite straightforward from a technical perspective. In this case, we've got, you're a CFO of a company, Yorkshire Pudding Limited, good British food there, YPL. YPL made an interest-free loan to a related party of just say $50 million during the year end 31 December 19. And that's actually a good point to mention. IFRIC 23 applies to periods beginning on or after the 1st of January 2019. So the first time which IFRIC 23 is going to apply for you will be if you have a year end 31 December 19 and after that. So to the extent you have half year reviews coming up, this issue will be live right now. So coming back to the case study, we're assuming there's an interest-free loan. We've assumed that assessing that interest-free loan based on its technical merits, it wouldn't be likely to be sustained. So in this particular situation, you're likely to get to the point where it's not probable that the approach that's been taken would be sustained. Notwithstanding this, in this case study, the tax office hasn't been in touch with you for a number of years. However, there is certain guidance online that says that there will be changes technically with respect to interest-free loans. So would you book a provision, under IFRIC 23? The answer to this one is a clear yes. You've got an issue, a technical issue. It might have some uncertainty, but it's reasonably clear that it's not probable the position would be sustained. While the tax office has not commenced a review, and while they haven't issued updated guidance, when you reassess this under IFRIC 23, it's clear that that provision should be booked. And the technical issue here is interest-free loans just aren't arm's length. If you're acting at arm's length, you wouldn't have an interest-free loan, you would charge interest. So that's the technical issue at stake. I think the interesting point that came out of this case study as well was if you have this situation, then you're actually likely to have probably needed a reserve under AASB 12 as well. So if you come across this sort of a situation, and this can easily happen when you've got a trading balance, perhaps with a related party that might run for several years, might grow in size, it might not be a problem for a first couple of years, but when you look back at it 2 or 3 years down the track, all of a sudden you realize, well, hang on, this looks and feels like a loan at this point, and that's something that a provision should be booked for. Might be a good point as well to mention with the introduction of IFRIC 23, where you've got an issue that might be a skeleton in the closet like this, something that you should have probably booked a reserve for previously, but now certainly have to book a reserve for, a provision for, sorry, then it's likely that there's an opportunity to work out how that goes through the financial statements in the first year. Maybe a letter I can pass to you on that one.
Yes, thank you, Mike. So, as you know, whenever we've discussed the new standards, AASB 9, 15, 16, the new standards always include some transitional requirements. And this interpretation also has transitional requirements. And it says on the date of your initial application, so if you've got a 31 December 2019 year end, date of initial application will be 1 January of that year. You've got various options. You can either apply it retrospectively and disclose it retrospectively, or you can have applied retrospectively but do a cumulative effect catch up in the current year, which is very similar to what we've seen with these other new standards. So basically, when you first adopt this new standard, you have this unique opportunity to get your accounting right, even for all those things that are sitting there in the past, and have a transition adjustment on your date of initial application, 1 January 2019. So that's a really good opportunity going forward. If we find things that maybe has not been picked up in a year or two's time, obviously that would raise a question on whether it's potentially a prior period error, and we don't want to be in that territory.
Yeah, thanks, Aletta. So that's key. The introduction of IFRIC 23 is a call to action to go back through those uncertain tax positions and appropriately document them. But it also provides an opportunity, if you do identify issues that need to be provided for now or potentially previously, because of the new implementation and the way that works, it might not be a P&L impact on that. All right, moving very quickly through the last couple of case studies. The second case study is designed to be more in the grey area. The technical issue at hand here is, let's assume you're an inbound distributor in Australia. You buy products from a related party and you sell them locally. However, you haven't made any money for a number of years. The technical transfer pricing issue here would be that the tax office would argue that if you make ongoing losses, if you were acting at arm's length, you would not continue to do business. You would close down that business, or you would change something to make money. Otherwise, there's no point doing business in Australia. So in that situation, the tax office might argue that those losses should not sit there and be recognized. They might ask you to cancel those out, or they might even argue that you should actually have made profits and you were there simply on behalf of a related party overseas. So with this case study, this demonstrates that you can have an uncertain tax position that can be very fact and circumstance dependent. There's no clear answer to this one, but the practical outcome from this one would be that you would need to put together robust documentation to support your position, assuming that you are going to argue that those losses were not due to transfer pricing reasons. So let's move quickly through case study 3 as well, just to wrap up. So case study 3, this one again is a technical transfer pricing issue, but it's related to practical issues that we've seen in Australia. So this case study considers an Australian company that produces goods that are sold to customers overseas, in this case in Asia, via a marketing hub in Singapore. And for those of you that are familiar or have read the newspapers about BHP Billiton and some of the challenges they went through with the tax office with a similar structure, we know that the tax office takes issue with structures where the Singaporean hub is remunerated on a commission basis, and that commission basis results in the Singaporean hub being attributed a significant amount of profit, which is typically greater than the cost base in that jurisdiction. So in this case, if we know that there's an issue that the tax office will take issue with, from an IFRIC 23 perspective, we need to consider the whole range of potential outcomes and probability weight each one when working out, well, first, obviously, whether the position is probable or not probable, and if it is not probable, what the expected value might be. So in this particular situation, you might be assigning probabilities to your position, to the tax office position, to the position at which you might be willing to settle, assuming that you had some sort of sign off from the board to say you could settle. And all of those broader considerations would impact both whether you would book a provision under IFRIC 23 and what the dollar value of that provision would be. So I won't go into any more detail in those case studies. I'll probably just leave you with a practical recommendation, which is that you need to be ready before the audit season kicks off to address the requirements of IFRIC 23. The call to action is to prepare that audit evidence that is required in respect of your uncertain tax positions. So that's preparing the binder, preparing the analysis for each uncertain tax position, and having management's view clearly documented before you end up in the audit situation. Typically, you might be comfortable dealing with the auditors directly on those issues, but in a number of situations, it might be useful to have a buffer between yourself and the audit team in the form of your own specialists who could end up talking to the audit team specialists around the technical issue to substantiate those views. But I'm conscious of time. I'm going to leave it there and maybe just hand back to Jason and Aletta just in case they have any last comments as well.
Jason, any final comments from a corporate tax perspective? I think although Mike have raised a number of transfer pricing examples, this could equally apply in corporate tax world.
Yeah, thanks, Aletta. Thanks, Mike. A really good summary, and the strong points I would make or I would endorse from Mike's presentation was that it's time now to start preparing for this. 31 December 2019, so the first year of application, that timeline is going to come around very quickly. And the first year of this application will be the toughest because it is in the first year in which companies will need to make an assessment of all of their open positions to successfully or effectively transition into these new rules. So it's time to start planning and preparing now. It will be if it comes to December, January next year to turn your mind to this, that's probably too late.
Thank you very much, Jason. And to also link up with what Mike and Jason have said, you know, these new interpretation standards always have that unique opportunity to have special transition requirements only in that first year, and to be ready to use that to the advantage of the company, understand what it means and apply them, implement them is really important. I would like to thank Jason and Mike for joining us on this webinar today. I really appreciate your contribution here. I also want to highlight to our clients who are attending that if you are looking for transfer pricing assistance, there are transfer pricing partners across all the capital cities at BDO. So you can contact your local BDO office and you can contact and come into contact with your local transfer pricing partner, or you can contact Mike and he can put you in contact with the appropriate transfer pricing partner to assist you. And the same goes for Jason. Obviously, we have our tax partners at all our BDO offices nationally, but if you have difficulty getting in contact with them, please feel free to contact Jason in the first instance as well. So thank you very much, Jason and Mike.
Thanks, Aletta.
If we then move on to Australian specific changes, a number of recent developments in Australia that I thought I would like to highlight as we get ready for 30 June 2019. And the first one, the Treasury Amendments, and you would have seen this in the press. It's been finalised. So the the Treasury amendments have doubled the reporting thresholds in order to determine whether an entity is a large or small private company. And we all know as soon as you're a large private company, you have to prepare, have audited and lodge financial statements with ASIC. So our current thresholds have been, if you meet any two of these three, you're a large private company. So consolidated revenue of more than 25 million, gross assets of more than 12.5 million, and more than 50 employees. Now those have doubled to 50 million, 25 million, and more than 100 employees. I think it's important to note here from an accounting perspective that it is consolidated revenue after you've applied the Australian accounting standards. So that would be AASB 15. And it's also gross assets after you've applied the Australian accounting standards. So that would be AASB 16 as an example, that in future will bring in right of use assets. So in order to make this determination, there is a requirement to comply with Australian accounting standards to make this assessment. The other thing is I would like to caution our clients to think about the consequences of this. If a entity that's currently large now becomes small, I think entities should still consider, whether there is a corporate governance reason to continue to prepare financials and have them audited, because we know there's a lot of benefits within having an audit done, a fresh pair of eyes. It's important for corporate governance purposes. We also know that there are other reasons that entities would have their financial statements audited, maybe requirements of a bank or a financier. So we would just caution entities to not move away from audited financial statements too fast, and to really consider the various benefits of an audit before they make that decision. If you're no longer large and you no longer have to lodge with ASIC, that is fine, and that's the requirements, but maybe have a good think about whether we should continue to have an audit. And then, so the implications for a company that becomes small, that used to be large, they no longer need to prepare financials, have an audit and lodge with ASIC. And I would really caution entities to discontinue the preparation of financial statements. I have some concerns around managing the organization. Have an audit. I really think there's such great benefits of having an audit. And having, independent auditors coming in, looking at processes, looking at controls, providing feedback on, controls, etc. I think really important, and for employees to know that there will be an annual audit. However, please note you must still keep financial records, and you also have to prepare audited financial statements if you're directed by ASIC or shareholders with at least 5% of the votes. So that's still something to consider. So that's the new Treasury Amendments. There's always the question, what about the grandfathered large proprietary companies? Now, no changes have been made to the requirements for grandfathered large proprietary companies. And if a grandfathered entity is now small, we do think they should actually consider to continue to have an audit and prepare financial statements in order to maintain that grandfathered status, because if they sometime in future, maybe after the adoption of AASB 16, as a result of the increase in gross assets, etc., become large again, that they still meet the requirements to qualify for the grandfathering. So that's very important, again, to not just jump at this new relief or, but to carefully consider the longer term implications. The next one I thought I'll highlight is the reduction in tax rates for small business. The Treasury Laws Amendment Act provided reduces the company tax rate to 27.5% for smaller companies carrying on a business where aggregate turnover does not exceed, and for the 30 June 2019 financial year, does not exceed 50 million. So aggregate turnover includes turnover of connected entities, so, parent companies, subsidiary companies, sister companies, etc. So where we have that reduction in tax rate, and if a client qualifies for that, from an accounting perspective, important to note that we'll need adjustments to the calculations of current tax and deferred tax. So just to be aware of that change as well. Another Australia-specific development is that the AASB has a proposal in relation to special purpose financial statements. And as you know, the AASB is busy with a longer project to limit the use of special purpose financial statements, where they are contemplating that as soon as an entity is lodging financial statements with ASIC or ACNC or a regulator that would make it publicly available, they would like those financial statements to be general purpose financial statements. But that's a longer term project, and where they continue to do consultation. However, in the interim, the AASB is proposing to require entities that lodge with ASIC and the ACNC to disclose compliance with recognition and measurement requirements of Australian accounting standards. So if we look at that at a closer detail, currently, if you are preparing special purpose financial statements and you're lodging it with ASIC and the ACNC, you have to comply with AASB 101, 107, 108, 1054 in its entirety. So recognition, measurement, and disclosure requirements. And then ASIC also has a regulatory guide 85 that says that they would require entities to comply with the recognition and measurement requirements of all accounting standards. So that's clearly the ASIC view. So what's being proposed is that both for-profit and not-for-profit entities that prepare special purpose financial statements and fall within the scope of AASB 1054, so that is additional Australian disclosures, so they have to disclose in the green box whether they have subsidiaries, and if so, whether they've prepared consolidated financial statements. And if they've not prepared consolidated statements, why not? There's been a long-running debate on whether consolidation is actually recognition and measurement or not. Or whether it's just a disclosure standard. So it's a process, it's a proposal to gather information and to make it clear to users what exactly a company have done. So traditionally, this would be a disclosure in our Note 1, compliance with accounting standards. In the block below, whether the entity has or has not complied with all the recognition and measurement requirements of Australian accounting standards. So it's important to note that this AASB proposal is not saying that an entity who prepares special purpose financial statements and lodge it with ASIC and the ACNC have to comply with all recognition and measurement requirements, although that is the ASIC view, and that is the BDO view. What they're saying here is they would, as a minimum, like those entities to disclose whether they've complied with the recognition and measurement of the standards or not. And then in the blue block, if they have investments in associates and joint ventures, whether they've accounted for these under AASB 128, which is equity method of accounting, in most instances, and if the entity did not comply with all the recognition and measurement requirements of the Australian accounting standards, please disclose enough information so users can clearly understand the accounting policies that you have complied with. So really, these AASB proposals are aimed at improving communication around exactly what an organization has done in their financial statements, to what extent we've complied with accounting standards, and if we haven't, what have we done instead? So exactly what is our accounting policy? When are these proposals likely to be effective? So the exposure draft is expected to be issued next month. They want to issue the final standard that require these disclosures by December. And then the AASB is trying to encourage early adoption or early voluntary disclosure even for 30 June 2019 financial statements. The next item that I would want to look at under Australian developments is corporate governance principles. The fourth edition have been issued for listed entities. There's still 8 principles. They've added additional recommendations to supplement those principles. There were some contentious matters that did not make the final edition. There were some talk about the concept of social license to operate, and there was also some talk about the requirement to put forward to avoid aggressive tax minimization schemes. Now, those 2 aspects didn't make it to the final 4th edition. So important for our listed entities to review these recommendations and to assess if they need to change anything from a corporate governance perspective, and then also the corporate governance statement would need to be updated. The next item, crowdfunding. So small proprietary companies can now access crowdsourced funding. So private companies with less than 25 million in consolidated gross assets and less than 25 million in consolidated annual revenue can now use crowdsourced funding to raise up to $5 million per year. So a big development, because small proprietary companies can now access crowdsourced funding without converting to a public company. However, there are some implications if a small proprietary company do make use of these crowdfunding requirements. So as soon as more than 3 million funds have been raised, and this is a cumulative amount, not an annual limit. So cumulatively, you've raised more than $3 million of funds. You will now have to prepare a financial report, prepare a director's report, lodge the financial report and director's report with ASIC, and an audit is required. So very important to consider that as well. Specific areas in Australia, next one that I would like to look at is the ASIC focus areas. Now, ASIC has not yet released its focus areas for 30 June 2019, but we expect these focus areas to be very similar to those released for December 2018. And the key categories, impact of the new standards, and I would say including IFRS 23, the application of the new standards. So are our accounting policies appropriate under these new standards? And then a very specific focus on disclosures. So ongoing disclosures under the new standards 9, 15, 16, but also the transition disclosures. So in that very first year of transitioning to AASB 9, 15, 16, there are very particular requirements around transition. And important to have a look at that, and ASIC will take a close look at those. Now, other focus areas expected to be similar to prior years. So the operating and financial review, non-IFRS information, impairment testing and asset values, revenue recognition policies, expense deferral, off-balance sheet arrangements, tax accounting, which is interesting given we've just talked about the new IFRS 23, and then also disclosure of key estimates and accounting policy judgments. And that is a really important disclosure, and it's becoming more and more important. We know these new accounting standards, new interpretations require a lot of estimation, a lot of judgment, and therefore we would encourage our client to really increase their disclosure around key estimates and accounting policy judgments. So that first part, I've looked at Australia's specific changes. I thought I would like to move on and talk about standards and interpretations that would be effective for the first time if you're doing financial statements for 30 June 2019. Now, this is a summary slide. The two new standards would be IFRS 9 financial instruments, IFRS 15 revenue from contracts with customers. There are also amendments to standards. There are amendments to IFRS 2 around the classification and measurement of share-based payment transactions. There are also some amendments out of the annual improvements cycle, and there are amendments to IFRS 4 around insurance contracts. And new interpretations that are effective for 30 June 2019, IFRIC 22 is already live and effective, foreign currency transactions and advance consideration. If we start to look at IFRS 9, now as you know, things to be aware of, the measurement of financial assets, so there's fair value, far more fair value requirements. You can no longer use the cost exemption. There are new categories of financial assets. Also to look at impairment, it's now the expected credit loss model, which should lead to earlier and larger provisions for bad debts. It's now easier to achieve hedge accounting, and then transitioning to IFRS 9, it's complicated and the disclosures are complicated. And there's also an interaction with IFRS 15, which is complicated around if you look at your revenue recognition, should we be applying IFRS 9 or should we be applying IFRS 15? So that's a complication that should be considered very carefully. You also know that we have, over the last 2.5 years, done numerous webinars for you on IFRS 9, and they are all available on our BDO Australia website. So if you just search BDO IFRS webinars, you'll get a whole collection of all those webinars over the last 2.5 years, including the ability to download the PowerPoint slides before you watch the recording. We've also, through BDO Global, released a number of amazing publications around IFRS 9. So there's particular ones, financial instruments, applying IFRS 9 to related company loans, which is a real big issue in Australia because IFRS 9 also applies to parent entity accounts. And then all separate financial statements here. And then also there's a particular publication around applying IFRS 9 to related company loans in the real estate sector. We're also very proud to release online training courses, and there are 3 associated with IFRS 9. So if you use those links, there are online training courses where you can work through the materials interactively. There are interactive examples, there are knowledge quizzes. So if you want to work through classification and measurement, impairment, and I would highly recommend IFRS 7 changes in the disclosure of financial instruments. You know, a lot of time has gone into understanding IFRS 9, but what does it mean from a disclosure perspective? We've released that online training course. So everybody happy, welcome and encouraged to use those. If we look at IFRS 15, I would say very similar. You know, we've got the 5 steps. We've done webinars on each step. We've done newsletter articles on each step. And we have developed a number of global publications. But in particular, the second one there, looking at transitioning to IFRS 15, is a very important and I think a useful publication for our clients at this stage. Also, we've developed numerous online training courses around IFRS 15, which using these links you can access, whether you want to know more about the various steps, whether you want to know more about principal versus agent, maybe transition or disclosure as you get ready for 30 June 2019. So online trading courses available to be used. If we come to the other amendments, there are amendments to IFRS 2. So these amendments clarify the accounting for various aspects of share-based payment transactions under IFRS 2. And I've discussed them very briefly over the next 3 slides. Now, due to time constraints, I'm not going to work through the details during this webinar, but I've included them. If you have share-based payment transactions, please be aware of these latest developments, so you could consider those. Annual improvements 2014 to 2016 cycle. There's been amendments made to IAS 28, equity accounting, and IAS 40 around investment property. Again, you know, if this is something that's of interest to your organization, please have a look. Amendments to IAS 28, you know, if we've got venture capital organization, mutual funds, unit trusts, or other similar entities, they may now elect to measure their investments in their associates and joint ventures at fair value, or they could use the equity method. And it also clarifies that that election is available on an investment by investment basis. So you don't have to treat all your investments in a similar fashion. And if an entity that is not an investment entity, they may retain fair value measurement applied by its associates and joint ventures that are investment entities. And also it clarifies that this election is available on an investment by investment basis. The amendments to IAS 40, if we look at investment property, it talks about there was old guidance for transferring in and out of investment property and the kind of evidence that was required. And now there's new guidance in IAS 40 for transfers in and out of investment property. So if you want to transfer investment property to owner-occupied property or property, plant and equipment, AASB 116, the evidence that would be required is development with a view to owner occupation. For example, a transfer might occur when the lease is terminated and there are firm plans in place for redevelopment that suits the client's specific needs to use it themselves. And when do we move from inventories to investment property? Apologies for that. At inception of an operating lease to another party. As soon as we've got that operating lease, we can now use investment property. Standard. If we look at IFRIC 22, foreign currency transactions and advance consideration, I think the best way to look at it is an example. So if we say on 1 January 2017, an entity enters into a contract to purchase a machine for $100,000 and payment must be made in full on the 1st of April. And the machine is delivered on the 30th of September only. So we are paying in advance. And they give us various exchange rates here. The 1st of April, when the payment is made, the 30th of June, reporting date, 30 September, when we receive the machine. Our functional currency is AUD, year end is 30 June. And what are the journal entries that we have to process to account for the purchase of this machine? And I think the important thing here is that we would account for that prepayment for the machine at the rate at that date, the spot rate on 1 April. And then very importantly, when we receive delivery of the machine on the 30th of September, that prepayment at that original rate, when we make the payment, will be recognized as machine or property, plant and equipment. As you know, normally under IAS 21, you would translate an asset at the date that you obtain control of that asset. In this instance, because there was a prepayment, you would do the conversion at the date of that actual prepayment. So this is a very important interpretation, and to make sure that you apply this correctly, where we've got prepayments, payments that we made before we actually receive control of the asset and therefore book the asset in our financial statements. So those are the standards and interpretations that are mandatory effective for your full year, 30 June 2017. If we move on to standards and interpretations that's effective for 31 December year ends, and therefore if you are doing half year accounts for your 30 June 2019 half years, the new standard would be AASB 16, IFRS 16, and I'll repeat that, as you know, BDO Australia has a technology solution that can assist you with transition adjustments and ongoing management. For ongoing management of leases under IFRS 16, that technology solution cannot be provided to audit clients for independence reasons. However, we can still, IFRS Advisory can still assist our audit clients with a impact assessment or transition adjustment on 1 July 2019. So please feel free to contact us if you need that kind of assistance. There's also amendments to standards, an amendment to IFRS 9, prepayment features with negative compensation. There's also an amendment to IAS 28, long-term interest in associates and joint ventures. There's some annual improvements, and there's also amendments to IAS 19, employee benefits. And then the new interpretation, which Jason and Mike discussed earlier, IFRIC 23, and we know there's a lot of work required to get ready for IFRIC 23. So leases, we've discussed this in numerous webinars, the impact on earnings, potential impact on statement of financial performance, especially the fact that your new asset, right of use asset, is a non-current asset, and your new liability is split between a current liability and a non-current liability. There's also a cash flow statement impact. Although the cash flows don't change, it will be disclosed very differently in the statement of cash flows, to be aware of that. And then also other potential impacts on bank covenants, ratios, interest cover, debt equity ratio. Impact on EBITDA, it improves EBITDA, bonus arrangements, and then system changes that would be required. Further information, we've also issued a number of publications around IFRS 16 that you can access, and also online training courses. So over and above all the webinars, online training courses that you can work through to determine the impact on your organization. Amendments to IFRS 9, and I'm just keeping an eye on the clock here. I've really well and truly gone over time. It's already 2 minutes past. So I'll just briefly touch on this. I expected to run into some difficulty to get this webinar done in an hour. Therefore, I've prepared extensive PowerPoint slides, where actually the IFRS Advisory team have prepared beautiful slides for me to use, so I thank them. I won't be able to work through all of them, but if you've got any particular questions, please feel free to contact any of the IFRS Advisory partners or staff, or your local BDO office. So some amendments to IFRS 9 around financial assets with early prepayment options for you to look at. Then also amendments to IAS 28 around impairment. So if we've advanced loans to an associate or a joint venture, which in substance form part of the net investment, but to which the equity method is not applied, how do we test for impairment, and especially the interaction between IFRS 9 and IAS 28, so a two-step approach. You test for impairment by applying the expected credit loss model, in IFRS 9 in the first instance, and then you apply equity accounting to the remaining balance, followed by an IAS 36 impairment test. So this is a weird and wonderful. You start with IFRS 9 impairment, then equity accounting, then impairment under IAS 36. So very important to have a look at that. Annual improvements. There's been some amendments to IFRS 3 business combinations, some amendments to IFRS 11 joint arrangements, some amendments to IAS 12 income taxes. So I'll just put that on your radar, as well as an amendment to IAS 23 around borrowing costs. So please look at that. Standards issued, not yet effective. There's new standards around insurance contracts, and there's also amending standards to IFRS 3, the definition of a business, and amendments to IAS 1 and IAS 8 around definition of materiality, and no new interpretations issued that are not yet effective. The IFRIC agenda decisions, I just wanted to highlight the fact that as part of our literature in IFRS world, we also have IFRIC agenda decisions. So people, when there's divergence in practice, people submit papers to IFRIC. The IFRIC consider whether that is something that they should take onto their agenda or not. Whether they think the accounting standards currently address the matter adequately or not. And if they take it onto their agenda, quite often it would lead to an actual interpretation, but that's a long process. Standard setting is a lengthy process. So what the IFRIC has decided to do a number of years ago is whenever they decide not to take a matter onto their agenda, they would publish their agenda decision, why they're not taking it on the agenda, and why they believe there's sufficient guidance. And these days they provide quite extensive discussions around why they're not taking it onto their agenda. So some of the agenda decisions that we've seen come through, so this has not gone onto the agenda, but the IFRIC have explained why they're not dealing with it, why they think the standards are appropriate and dealing with the issue. We've made a list of, and you can see all the various standards that's been addressed, quite a bit on IFRS 15, IFRS 9, but also some other standards where there's been agenda decisions. So if you run into a particular issue and you want to see whether maybe IFRIC has considered it because there's no standard, no interpretation, that's another resource available to you. Our not-for-profit developments, just last month we did a session specifically for not-for-profit entities. So the standard for them that's effective 30 June 2019 is IFRS 9 financial instruments. For 31, for effective for the first time 31 December 2019, there's a whole collection, AASB 15, AASB 10, 58, AASB 16, so they've got 3 big standards in 1 year, a number of amendments to standards, as well as 2 interpretations. So it's really a big bang when we look at 31 December 2019. However, 30 June 2019, only IFRS 9. And then issued, not yet effective for our not-for-profit entities. There are some new standards around service concession arrangements looking at grantors, also insurance contracts, and also amendments to standards around IFRS 3 and IAS 1 and 8. No new interpretations. For not-for-profit entities, there's new AICD governance principles that's been issued for not-for-profit entities. A fantastic publication, highly recommended to consider for governance principles, particularly aimed at not-for-profit entities, which we know is a different place to operate in, different challenges, obviously different strengths as well, a very good publication to work through. We also know there's requirements around reporting requirements with the ACNC. There are some existing thresholds. There are also some potentially proposed thresholds. So these are the recommendations of the review panel. They've not been mandated yet, but this is potentially thinking. So just for your information, what could happen in future. We know our not-for-profit entities have been troubled by the requirements in the new AASB 16 to fair value right of use assets under peppercorn leases, and the AASB has now provided an option to defer that requirement. They've decided that at their November meeting, and it was actually issued in a standard AASB 2018-8 in December, 21 December. So we don't know when it will become mandatory applicable. Then there's also some developments around Victorian incorporated associations. I've included the slides, as well as New South Wales incorporated associations, and a new standard's been issued for implementation guidance for not-for-profit public sector licensors. So important to apply that if you're in that space. If you need any assistance, our technical team, the leaders in the various cities, please feel free to contact any of us. We would appreciate if you could contact us. Happy to work with you and guide you through the next few years, where we've got a lot of new accounting standards coming in. Also, our larger team, you will see on the top right-hand corner, Dean Arden is a new recruit. He started at BDO on the 29th of April. So fantastic to have another person join our team. This is a large team. We are very proud as BDO Australia of our large IFRS advisory team, their knowledge and their experience and their expertise. So please feel free to contact any of them if you need any assistance. I do apologize for running over time by 10 minutes. I hope you found the session very useful, that it at least put on your radar the things to consider for 30 June. And if you've got any questions, please feel free to contact me or any of our experts. Again, thank you to Jason and Mike for joining us today. I really appreciate your time in helping us. Thank you very much, everybody. Have a good day.